Welcome to Introduction into the Market, section 401. We're going to talk about market makers. You'll hear that term a lot, and you'll hear a lot of things blamed on market makers, but let's go through and figure out what they are and what they do. So again, Investopedia, you can read more about it, go in depth. It's got a little video on there that you can watch. But put simply, it's a market maker is a firm or individual who actively quotes two-sided markets in a security, providing bids and offers, known as asks, along with market side for each. Okay. So what are they saying? Well, when you switch to E-Trade over here, you see this on the right side of the screen. You've got GME, CAN, whatever stock you go to, you've got what's called the bid right here and the ask right here. And this is your size, meaning the shares and size. Okay. So what you have here is market makers saying, you know what, I'm willing to bid at 83.27, and then you got someone that's saying I'm willing to sell at 83.28, and so that bid ask spread is 1 cent. If you look down here at GME, it's a little bit different. You see how it's 204.25 versus 204.33, so you've got a 13-cent spread, bid-ask spread there. Now, the purpose for market makers is to literally provide liquidity, and so they have to have offers and asks and bids up to provide liquidity, because maybe nobody's buying the stock. Well, they need to have it up to provide a market. Okay. So right here, this gives you, when you scroll down to frequently asked questions, this gives you a little bit more information. The way that market makers make money is through this bid-ask spread. And a lot of times they'll actually be what's referred to as the ax, the person controlling the price. You'll be able to see them on the tape, and we've got more lessons about the tape. You'll be able to see them on the tape on time and sells sitting at certain levels absorbing. So let's just pretend sitting at like 200 on GME, absorbing, taking all the shares that people want to sell just to hold that price up. And then once it shoots up to 204, 205, then you'll see a large distributor there. Well, that's the market maker, and he's making $5, right? So there's a bunch of different ways that market makers earn their money, but the main thing to remember is it's through the bid-ask spread. Now, you have orders that are called like hidden stop orders right here, and that keeps your stop order in-house, meaning whatever brokerage you use is the only one that sees it. Because a market maker, they can see all of the bids and all of the asks and the size, right? So, well, what does that mean? Well, let's just pretend you've got an order. You want to buy GME if it gets over 205. You think that's a level it needs to break through. Once it does, you're all in, and you're going to buy 10,000 shares at 205.01. Well, what do you think the market maker is going to do? He's going to see your bid. He's going to run it up to that, fill you, and then drop the price. Okay. So that's where market makers get a bad name. The other way they get a bad name is, let's say you want to stop out at 204.01 and you're going to sell a bunch of shares. Well, it's called a stop run, and a lot of times the market makers see this. They run down there and they take it out, and then they just bring the stock right back up. So that's when you'll see stocks that do this. They'll go down and then they'll just come right back up, or they'll go up and then they'll just come right back down. I call it a liquidity chase. They're looking for liquidity and they see it, and then, you know what? Let's go get it. Now, with that said, unless you are trading with absolute enormous size, no market maker cares about your bid offer. You are like, you're not even a minnow in the ocean. You're literally nothing. They do not care. Okay. What happens most of the time is everybody sets their stops in the same general area. And so the market maker simply uses human psychology to stop loss people. So to give you an example of this, where do you think everybody's stop was on this particular stock, on Crowd? Well, We don't want these making lower lows, right? We don't want it to go underneath this and underneath that, right? So look at what this particular one did. You see how that little wick right there? It just went just below that. Well, why? They were going to try to stop run people out. And it just got bought right back up, right? So that's just an example of it. Remember, if you are losing money, it is not the market maker's fault. It's your fault. And one of the things about trading is taking accountability. You are in control of everything. I promise you, until you are trading with millions and billions of dollars, the market maker's not paying attention to you. They're just using what's common stop losses and things like that. So that's it about market makers. If you have any questions, just let me know.